Restrictive rules for passive investment income affect how much of your Canadian company's active business income is eligible for the small business tax rate. This has a dramatic effect on the amount of corporate taxes you have to shell out. For more details, you can watch the video on the top right. The passive income rules can create new challenges for business owners, but proper planning can help. Hi, my name is Amandeep and I'm a CPA practicing in the Metro Vancouver region of British Columbia, Canada. I hope that you and your family are safe during this difficult time. In this video, I will discuss 5 strategies that you might consider to reduce passive income for this year so as not to lose the small business deduction next year. The first thing that you can do as a small business owner is to consider maximizing your RRSPs. You see, you might want to consider paying enough salary or bonus each year to get the maximum amount contributed to the RRSP. So take up the money out of the corporation and make an RRSP contribution. Similarly, consider paying enough money out of the company to make a TFSA contribution. Why you should do so? You see, when investment income is reinvested inside of a corporation, you're paying very high tax rates on passive income, whereas inside of an RRSP or a TFSA, the tax rate is 0. Second idea is to look into the books of the company to see if there are tax-free withdrawals that can be pulled out of the company. So we are thinking things like shareholder loans. If you've loaned money to your corporation, why not take the money back on a tax-free basis, reducing the amount of cash sitting around inside the business that otherwise might be generating passive income. Similarly, if there is a balance in the capital dividend account, get it paid out as a tax-free capital dividend to reduce your accumulating retained earnings in the company that otherwise might be attracting the passive income. Review your investment strategy and consider focusing more on capital appreciation rather than income-generating assets. This strategy defers the tax liability until the asset is sold and a capital gain is realized. So maybe you want to move the corporate-owned passive investment in the company to a portfolio of securities that's generating mostly capital gains. Why capital gains? Well, because first of all, capital gains are not realized every single year, and second of all, capital gains are only 50% taxable, which means it would actually take $100,000 of realized gains to get $50,000 of passive investment income. So again, look at the portfolio and see if there's things that you can do in that portfolio to minimize the amount of annual passive investment income. Look at something called an individual pension plan. It allows you to contribute tax-deductible dollars from the corporation into this plan. You see, you're effectively removing money out of the company, and therefore that money is not earning income in the company. That would then count towards the passive income test of the $50,000. The final idea is looking at the use of corporate-owned permanent life insurance. So universal life and whole life policies, if the corporation takes excess funds that are not needed for the business and not needed for retirement and invest those inside of a permanent life insurance policy, all of the investment income is sheltered inside the policy. So it's not included in the corporation's passive income anymore, and on death the entire benefit can often be paid out as a tax-free benefit to the shareholders through the capital dividend account. Your CPA can plan the proactive steps that can be taken now to potentially mitigate the risk of higher taxes in the future. If you want to be notified about our new tax updates, please do consider subscribing to our channel. Thanks for watching and see you in my next video.